We're going to talk about investors. People generally want to talk about investors because that's what they want in just about any startup, any company. Investors, how are investors' priorities changing on the rebalanced investment landscape? Here to talk about it, please welcome Daria, Gherghelas, associate at Speedinvest, Marta, Mrozowicz, investment manager at HealthTech, Dr. Nicholas Deakin, executive director at Morgan Stanley, Benjamin Belot, partner at Kurma Partners, and our moderator, Dominick, Kennerson, senior vice president, HealthTech, HSBC Innovation Banking. Welcome. Please join me on the stage. Don't be shy. After all, we've already had 10 panels. You just happen to be 11. And I'm sure we're going to have a very interesting conversation. And given the comments earlier, I'm glad we have two women joining us for this discussion, not a male-only panel discussion this time. Ready?
Yeah, absolutely.
Enjoy.
Testing 1, 2. Thank you. So slightly different format, I think, for this panel. We will have maybe about 10 minutes or so for questions. So be sure to take some notes along the way. Why don't we do maybe deeper introductions? We'll start here to my left.
Hi, everyone. My name is Marta. I'm an investment manager at HealthTech. We're a 100 million fund based in Berlin, investing in digital healthcare in Europe, mostly at seed and Series A. Yeah.
Hi, everyone. I'm Ben. I'm representing Kurma Partners. We are a healthcare-focused fund based in Paris and in Munich, and we invest in biotech, health tech, and tech bio. Myself, I'm a partner in the health tech and tech bio team. On that topic, we invest in pre-seed and seed in the European Union across many topics. Just to give you maybe one example, in health tech, we seeded Cardiologs, a company using AI to analyze ECGs that was sold to Philips in 2021. And on the tech bio side, we're early investors in DNA Script, a very interesting company using a DNA printer to facilitate the printing of nucleic acids.
Thank you. Hey everyone, I'm Daria. I'm representing Speedinvest. We are a pre-seed and seed stage fund investing across Europe. So we have different offices, London, Berlin, Munich, Paris, and Vienna, and a separate health and tech bio team. So we invest in digital health and intersection of software and bio. It's mostly platforms and software. So far in the vertical, investing in 25 companies, and now are at our fourth fund generation, which is 300 million, investing ticket sizes up to 2 million.
Perfect. And I'm Nick. I'm an executive director at Morgan Stanley in London. So we advise across EMEA, larger and kind of later stage in health tech. So I lead a lot of our efforts in health tech across Europe, both on the HCIT and the digital health side, and actually worked with most of the European unicorns over the last few years. And then prior to this, used to be a medical doctor, also in London.
Thank you. And just by way of introduction, Dominick, Kennerson with HSBC Innovation Banking. I'm based in London from the US, have a pretty deep background in digital health. Joined the bank in January from Bayer Pharmaceuticals, where I was leading G4A. And I've been hugely looking forward to this panel, in part because some of these people are my friends and I've known them for a few years. So this is the conversation that I would probably be having out in the hallway or somewhere else. So hugely excited that we could actually bring this to everyone else at HealthTech forward. So maybe we can just kind of set a little bit in terms of what does this topic even mean, navigating the rebalanced investment landscape. How are investor priorities changing? And I think we are all very much close to the data. We all kind of see the numbers. I think what I heard in London and through most of the world earlier this year was that, I don't know, Q3 would be the magic quarter for health tech and digital health investing. And like nothing happened, right? It was a nothing burger. And so then October, there seemed to maybe be some green shoots. I don't know, what have you been seeing? What has changed for you from January until now? We're knocking on the door to December, so pretty much we can look at 2023, I think, with some degree of retrospection. So why don't we start with you, Marta?
Yeah, that's the same story we kind of were telling ourselves. But I was just having this conversation also in the corridors with other investors. to me, it feels like this year was really the year of market repositioning itself. I feel like we've seen a lot of deals, but not that many that we got really excited about. And it also felt for me that the market had almost like two speeds. There were like certain hot spaces, for example, anything with generative AI and co-pilots and AI, where like deals closed really quickly, and there were like very early stage deals that were like pre-seed raising seed-like amounts, and there was like stuff that took like months to close, like a very long tail. And what we were missing is like this healthy middle. Like I can't remember the last time where I've seen like a really good seed round in health tech, where like the founders were like, you know, hitting all their milestones and had a clear PMF, and the valuation was also like working for us. So that was kind of what we've seen. I mean, the year is now almost close to closing, so we'll see. Maybe there's something still that's gonna come out of the woodwork, but overall, I feel like it was a very weird year.
Benjamin?
Sure. So I invest at the seed stage, and I don't think it has changed very much. But starting from Series A, we're seeing much more scrutiny on the commercial metrics, which, you know, in a way is fair. I feel that the biggest challenge for health tech companies is adoption. And by adoption, I don't mean just a small-scale pilot that is almost free, but to, you know, generate sustained revenue. So that needs to be addressed. I would also echo Marta's points on the two-speed market. I feel that the situation, in a way, is very black or white. Companies with traction, some of them, they still raise like it's 2021. You know, it happened for one of our companies that got 7 term sheets in a month. And for others that may be a bit late on their business plan, you know, everything takes longer in healthcare. It doesn't mean that the fundamentals of the business are wrong. You know, it's just going a bit slower than expected. But for some of them, it's really hard, and it's a bit cruel.
Daria?
Yeah, I mean, echo 100% what both of you said. And I think it's also worth noting that there is quite a big difference between what happens at pre-seed and seed stage and at growth stage. I think the market was less affected and the correction was less steep compared to Series B+. So we are still seeing a lot of investment being made. I think actually this year was one of the highest number of investments into the space. So that's a good signal. And also, if you kind of step away from what happened in the 18 months after 2021, there is a decrease from that steep number, but still looking at the past 5 years, the number of investment and the capital invested in venture is still growing. So I think, yeah, that still shows that the European venture capital landscape and startup sector is resilient, and there is still a lot of opportunity. So yeah, excited for what's to come, and yeah, I can only echo the two speeds in the market. We are also seeing kind of the AI sector booming. Investors are paying a premium for companies in the space, and yeah, you don't see that maybe in the rest of the sector.
Nick, how does this relate to your work?
Yeah, I mean, look, I think coming just from a slightly bigger perspective, I think the biggest things that have changed, at least when we talk to both investors and founders, are that we spent all of last year with companies saying, we understand that the market is down from the peaks of 2021, but it shouldn't affect us because we've grown or we've hit our plan, or, you know, they always have reasons why they wouldn't have been affected for a private company in Europe when you look at the public peers in the US. And I think there's been more realization this year from founders across the board that there is a bit of a, as it says here, kind of rebalanced valuation paradigm. And I think that's shifted a bit, and it's starting to shift in founders' heads, which I think has been helpful at getting some stuff out. But the two-speed thing can't be echoed enough. And I think when you get to the later stage, now it becomes around how far are you away from profitability and what are your unit economics. And those two things seem to be the discussions that we are having all the time with companies and with investors. And that seems to be where you'll either be a winner or a loser in this market. And I think that's just on the more advanced company side. That's the amount of DD, and I guess it's actually across the board, has really gone up on that. Does every incremental sale does it contribute to your margin? And if not, do you have profitability in the next 6 months, 12 months, 18 months? And that's a key question.
Yeah, and I think building on that, I have a bunch of thoughts. In part, those two speeds, I definitely want to double click on that because we have a number of startups here. Of course, everyone would prefer to be in that fast bucket, right? And I think one of the questions is, how do you what do you look like to be in that fast bucket, besides just putting AI in your title? I think something else, and I have to say that Julian is joining next. He's in the back, so stay tuned for Galen Growth. Julian had some really interesting data, I think, that came out earlier this year, I think after Q1, and it essentially said, even at that point, that nearly 60% of the companies that raised in the last 18 months in Europe had not raised. So essentially, we have this bucket for speed, but there's also probably a bucket for Series A companies that need extensions, that maybe they don't have the unit economics, that need investing in fundraising, and where do they kind of fit into this narrative and into this equation? So what does speed look like? What do those companies look like? How do you kind of dig under the hood besides .ai in your website? And then what about the companies that we actually invested in 18 months ago, that maybe haven't raised and need to raise? Anyone?
Yeah, I'm happy to jump in here. And I think, maybe it's something that less applies to us because we invest kind of before that Series A stage. But I did hear from many later stage investors that there are a lot of opportunities that are heavily discounted now. And it's a lot of kind of those companies that maybe raised 18 months ago and now are running out of cash and needs to raise again. And usually you can get in at a good price in there. And also just on the AI comment, I think always AI, you're not building necessarily AI. I think AI should be just a tool to solve another problem. So I think always when we are looking at companies, we try to start from the problem, what exactly is happening here, what is not going well, and if AI can be an application and can actually add value, then great, you should do that. But it was also said earlier, I don't think we should just kind of slap AI on a deck because it sounds cool and it will get us money.
Yeah, maybe one comment on AI. I'm genuinely very excited about what new technologies can enable us to do. I remember what speech to text was a few years ago. The performances were really not up to par with what's required nowadays. But indeed, I think we will see a lot of companies that are putting the technology forward, like it's a magic wand. And as excited as I am, I think that the AI companies that will win are the ones that really focus on product and how they deliver this technology to solve a problem. Product and distribution channel. I feel that this is sometimes overlooked, and it's a big challenge. So that's my take.
Just building on that, unless Marta, did you want to say something?
No, I just want to second that and say that from our perspective, we also get excited about AI, but actually the deals that I think we also seen got quite competitive this year had nothing to do with AI. They were just like old school software, because I think it is, I think what we're really looking for is, a great product market fit, decent growth that is also sustainable. So to the point of about like unit economics, that's already something that matters to us at seed and Series A. And for us, it's also about scalability, because we are believers in power law at Heal. We believe that each startup we invest in can become the unicorn, but becoming a unicorn in Europe in digital healthcare is not that easy, right? So the bar is also quite high here. But if you can tick all of these boxes, you don't have to be a Gen AI company to, I think, raise a really good round.
Yeah. So AI, I think, I'm absolutely a data nerd, and something I did earlier this year was I actually looked at the FDA list of approved AI technologies, and I looked at the number of those companies that are actually still in business. You would be surprised in terms of how many are not. That's all I'm going to say. So I think it's distribution, I think it's the scalability, and then I think it comes down to how do you actually make money along that value pathway that we talked about. I think I do want to kind of get to your point around unicorns, because I think this is where Nick comes in a bit. Nick, what's the case for an EU unicorn? Like, what does that actually mean?
I mean, I think some of the things we heard about already are important, but I mean, I think everyone acknowledges it's harder to build a unicorn in Europe because of the regulatory boundaries and what you don't have. It's a bit like a US company that's only in one state and then decides to go to one other state. It would be very hard for that company to be a unicorn, right? So therefore, in Europe, you see multiple speeds in terms of adoption of digital health. You see multiple speeds in terms of doctors' willingness to adopt things. You see multiple speeds in terms of patient willingness, and then you see these regulatory landscapes which are very different, even as you cross a border between Germany and say France. Like, it's totally different in terms of what they will and will not accept. So I think it's seen as hard from a regulatory point of view. Is it possible? Yes, we've seen it. There are companies that are doing well, and there's companies that have managed to scale both within continental Europe and the UK, and then start expanding outside of that. There's few examples of those. There are other companies that have really doubled down in one market. Particularly if you think about healthcare software and deployment, you'll see there are certain regional or national champions in France, Germany, Italy, the UK, the Nordics. And you'll see that some of those companies were starting to expand. And I think actually 2021 threw a bit of a spanner in the works in terms of expansion, just because money became harder to get hold of, and therefore it becomes much harder to persuade people to back that expansion story. So M&A becomes harder despite the change in valuation levels. So I think just harder but possible is my answer there.
All healthcare is local. Ben wants to say something.
Yeah, just one thing. I think it's one thing to be labeled a unicorn, to get this price tag when you're raising money in 2021. It's another one to exit as a unicorn. And if I take just an example, in France we have Dr. Lib, one of the famous unicorns, amazing company, absolutely amazing execution. So there's nothing wrong with them. But when you look at the price tag, it makes you wonder, who's going to be rich enough to acquire you? Is IPO really an option? In the US, probably not, because your market is all in Europe. Being listed in Europe, it's not the same. It's not the same liquidity. So yeah, I think once we see a unicorn exit in Europe, we'll have really achieved the milestone.
Marta, you look like you're wanting to say something, maybe.
No, I mean, I completely agree. I think we wouldn't be here and he wouldn't be here if we didn't believe it's possible, right? It's just harder in Europe because of the regulatory landscape. There are some champions like Doctolib, but I think exits remain a big pain point in the space, right? And I think that's still, I think, the part that's missing a little bit when it comes to the ecosystem.
Yeah, I mean, I think on the regulatory point, I was a lobbyist with Bayer for about 4 years, so worked quite a bit on the policy side. And I think the one reference I like to mark, is kind of the health technology assessment, which started in Germany somewhere around 2010. And I was actually in the office at the National Statutory Health Insurance Association in Germany when the French legislators came in and said, hey, we want to adopt this. I moved back to Germany 2 years later, and then it was an EU-wide kind of an approach. And so, I don't know, I do wonder when it comes to AI, we do have the Artificial Intelligence Act that's taking some shape. I think there was an early readout maybe 18 months ago that act would significantly impact businesses in the EU. I think there was a report from the Center for Data Innovation that said that if you are an EU startup, for example, and should say that if you were a healthcare company, essentially you're already in a high-risk area under the Artificial Intelligence Act. Second piece was that if you have a net revenue of 1 million, you have to pay 40% of your net income to meet the standards of the Act. So I think it's something to keep an eye on, because I think there is legislation that's happening at the EU level. I don't know if the market is mature enough to be able to translate, adapt, respond to that, especially when it's at the EU level. Bit of a segue, but let's get back to the exits point, because I think, it's all about value creation. And I don't know, I'm curious in terms of, Nick, your experience, what do you see from an exit perspective? How do you kind of see 2024 shaping up? That has been the conversation in the corridor today, I think.
Yeah, look, the best example I can think of, and I guess the one that everyone is thinking of, it's probably not the Babylon SPAC story, but it's probably more the Amazon One Medical story, in that, this is a player that we all know that used to deliver books and now does a lot more, right? And then decided that they would build an infrastructure around pharmacy and distribution of healthcare products in the US, and then basically went and bought One Medical, and we've all kind of seen the news, which has been really positive over the last few weeks about the rollout of medical care through One Medical. We helped advise there. I think that's a really important, story for us to hang on to when we're thinking about exits, because it's not an example of a company buying in their core, but it is a company which is basically looking at vertical and horizontal integration and basically getting more out of their existing customer base and offering more. And I think, there's the strategics, there is the healthcare IT companies, there's the medtech players who are all looking to solidify and basically get sticky customer base. And if you think about the kind of products that a lot of digital health companies are building, they are sticky, they have sticky customers, they have good relationships with hospitals, doctors, patients. So that's something that's appealing to pretty broad set of companies.
I have to challenge you to kind of double click on that that comp, because I think Amazon, so what does that actually mean for a company in the EU, right? Because Amazon in the EU, for example, they're under a lot of pressure from regulators, right? So how do we actually translate that experience to, this market?
Maybe I don't want to say too much about competition concerns, but I don't want to go there too much. But I think more the point is that there are acquirers, right? And there are people who are willing at scale to get the kind of embedded relationships, revenues, and technology that they need to basically solidify their core business. And it may not be Amazon, right? It could be any of the other big strategic groups we talked about.
To the VCs, what are you looking for from an exit perspective, Daria?
Yeah, I think it's also worth mentioning, especially for the founders in the room, because we keep talking about unicorns, but I think not all companies need to be a unicorn. Also from an investor perspective, it depends also on your fund size and whether you can make the math work. But for example, from a founder perspective, a 10 to 20 million exit can be life-changing. And I think also we are seeing exits that are more in not the billions stage, but a couple of hundreds of millions that can also move the needle for a fund. It depends, again, on the size of your fund. So I think you should also go kind of a bit targeted in your fundraising, depending on what you are building.
Anyone else?
Maybe a quick comment on One Medical, and maybe to see the glass half empty. I think it's a good story in terms of exit, but it's still a company that's unprofitable. They came with the promise that they're going to use tech. They're going to streamline the processes and make it more profitable than a traditional clinic, and they haven't really delivered on that. So I guess there's always two sides to the story. Regarding exits, I guess in general, one criticism that you could bring to venture capital as an asset class in Europe is that there aren't enough liquidity options. There's not really any structured PE sector that can do secondary and provide us with with these liquidity options. So we have to rely on M&A and IPO. IPO, we know that it's great if you can do it in the US on the NASDAQ, but if the window is not open, then, well, it's not open. Acquisition, you have to find players that have the the shoulders to do it. So it's really, I think it's really a tricky question for all of us in VC.
Well, haven't we seen the acquisition and kind of merger activity this year that, again, everyone thought that we would see in Q3, again, the magic quarter?
Well, most of what I've seen, and my data could very well be incomplete, but is more, like bargain price type of acquisitions for companies that are struggling. Now, I think in some cases it's good that there is some concentration and that you build a bigger player that's more likely to get scale, as opposed to everybody dying because they're too small and they cannot reach critical size. But it's another type of acquisitions, let's say.
As promised, I did want to open it up to the floor, I think, in a more conversational way. And we have at least one question. Is it Thomas? Yeah, Thomas, what's your question? Is there a mic coming around?
Yeah, I can share mine for the time being. No, your voice is not strong enough.
Hi, thank you. The number one question we get to the startup from potential investors is, when are we going to the US? Does this factor in your plans as VCs, or is this a consideration for a VC?
Yeah, good question.
Our mandate is to invest in digital healthcare in Europe. So we actually want to see startups growing in Europe, but we know it's difficult because of what we've just mentioned. So it's almost a given that a lot of the times founders want to go to US. And I think, we don't have a problem with that. We don't, let's say, challenge that. But I feel a lot of times founders are also a bit naive in thinking how easy it is going to be versus scaling to another country, right? That's just kind of our perspective. I wish founders would rather sometimes did better research and try to understand where it would be really easy and comparable in terms of scaling and go to market to go to, instead of and now we're going to US, this super large market that is going to be entirely open to us and it's going to be all dandy. I think that's definitely usually just wishful thinking a lot of times.
Yeah, no, that's right. But I guess it also depends what you're building in the end, because there are certain models that maybe work better in the US. For example, if you look at kind of B2C businesses in healthcare, they tend to work better in US. So yeah, it depends a lot on what you're building. But you don't necessarily have to only sell the US kind of story if that doesn't make sense for your business.
Yeah, I very much agree with Daria. I think that, in some cases, it makes sense to develop your business in the US. And usually my comment is, don't waste your time in Europe. If you feel that your product is a better fit for the US market, you put all your resources on this market because it's a tough one. Other models, to take the example of Dr. Lib, it makes sense to do it in France. Doesn't make sense to bring it to the US. So, I guess in a nutshell, the answer is it depends.
I think as a commercial bank, what we see is that I would say the majority, so definitely over 50% of companies in Europe have their minds, hearts, vision set on the US. I think there are a number of kind of graveyard examples of companies that have done that and have been very much challenged. I think especially there was maybe two panels ago about kind of point solutions. So do you really go to the US, with a point solution? Do you really go to the US without US investors? I think there are a lot of nuances in actually going to the US and being successful that come into play.
Hi, I've got a question pretty much for all of you, bouncing on what Ahuti said earlier on, where we are seeing, because of the pressure that's been put on late Series A, Series B, and that need for unit economics, specifically in the direct-to-consumer, is the direct-to-consumer seed investing extremely pressured for you guys at the moment? Is it gone, or is it momentary? What's the state of affairs there?
I think there might be still pockets worth exploring, especially if, I think we're looking usually at areas of healthcare where the out-of-pocket spend it's still very high. So I don't know, thinking about dentistry or something in this area. It depends again. I guess that's the answer to most things. We shouldn't probably generalize. It depends a lot. But I think if it's a market with a very high out-of-pocket spend, then we would definitely consider.
To be honest, I think it's really tough for D2C companies to raise at the moment. You need a very compelling case with strong unit economics, which is difficult to have at the beginning because you don't have a lot of hindsight on your long-term value. We do have a B2C investment together with Speedinvest, so we are a believer in the space. I'm still 100% convinced that there is room for great B2C companies in healthcare. But yeah, to tell the truth, it is tough at the moment to raise money with that go-to-market.
Yeah, I can only second that. I think it takes something extraordinary in terms of traction for us to get interested in this. Also, to Daria's point, I think what mostly makes sense for us in Europe is where the out-of-pocket spend is high, and that's usually dentistry, I don't know, childcare, maybe elderly care. But everything else, unless it's something truly exceptional and you've managed to crack, something that nobody else has, it's very tough.
Speaking of tough, expect another tough question.
So I'm thinking about your comments earlier on about the difference between early stage and later stage, and how that's shifted or not shifted. Would it be fair to say that as an early stage investor, potentially, you do have to keep more powder dry to do follow-on investment for your existing portfolio because it's potentially tougher for them to raise later on, because we are seeing an increase in bridge rounds, for example. And so to safeguard your return, you're then having to keep a portion of the pie to do follow-on rather than new investments. Would that be fair? And if not, just would love to understand your perspective.
Well, I mean, each fund has a different strategy. For us, I think from the start, we kept a large percentage of the amount we raised for follow-on rounds. So whether this is used for bridges to support companies or larger rounds, the money is already flagged. Not just for when we come in at the seed stage. And on our end, we don't have like this very defensive strategy to say we should do less investments or be more mindful because of the environment.
Yeah, I think for us it's a similar strategy, and what I usually advise founders is to try to optimize for more runway from the beginning. So kind of looking more into the two years and a half span. So maybe you don't run into that problem and you have enough time to build the proof points so you are able to raise the next round. But we also have a very large proportion of our fund allocated for follow-on investment into our portfolio companies.
I think it's also fair to say it's across the board. It's not just early and growth stage. It's right the way across. So even the companies that raised in 2021 at the peak and raised loads of money, if they're not at a stage where they're profitable today, a lot of them have, and some of it's public and some of it's not, but done extension, sometimes 2, 3, 4 extension rounds of very small rounds that are from the existing investors that have kind of helped get the company along to a point where they are more profitable, and then to a point where hopefully for that company they're able to justify either the valuation that they were before or at least something that's approaching that, as opposed to going out to the market afresh.
Yeah, I mean, exactly that. Every fund has their own strategy. We also have a portion of the fund allocated to follow-ups, but I think in any case, we always need to believe that in the company and that we're investing in something that can still be a portfolio winner, right? I don't really believe in throwing good money after bad, and that's probably why we're going to see a lot of more write-offs soon.
Maybe time for one last question.
Exactly. Besides, the moment you hear two metaphors like pie and powder in a single question, you know it's going to be interesting. 1 minute, ladies and gentlemen. Anyone?
If not, maybe we'll have famous last words from the panel. Thoughts into 2024, what's top of mind, what's driving valuations, what's going to change, what do founders need to know from you? Nick?
I would say path to profit and proving that your unit economics work.
I wanted to say the same thing.
Okay.
So yeah, having a strong business model, proving that your unit economics make sense and it can work. And yeah, I guess we also try to think about that when we invest at the earlier stages. Of course, there are no proof points and the jury is out. But yeah, I think we need to think about it from start and not delay the conversation, because otherwise we've seen many companies who in the end didn't make that work and ended up failing after they raised hundreds of millions. So it's definitely an important thing.
Yeah, I'm not super optimistic on 2024. I think a lot of companies got bridge financing. The money's going to run out. A lot of them are going to come back to the market to raise at the same time. We're starting to see some high-profile bankruptcies in the US. There was Olive AI last week. There was Calibrate before. So yeah, I think focus on surviving.
Yeah, exactly this. My advice to the founders is definitely it's not going to get easier. This is not a momentary thing. The valuations will not going to go back to what they used to be. Prepare to be scrappy, prepare to bootstrap if you need to, and yeah, plan for the worst, really.
And all I would say is Julian was in the back nodding emphatically, so stay tuned for Galen Growth up next. They probably have some data to unpack around this. And thanks so much to the panel.
Nicholas, Daria, Ben, Marta, and Dominic, thank you for chairing the discussion. Thank you so much again.